Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, September 7th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual investment advice. It's for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, let's get started. So this is kind of like the big news recently. The yield curve basically has uninverted. What's the significance of this, you ask? Basically, in the past, as you can see, the gray bars are well, first of all, what is the yield curve inversion? So you have the 10-year yield minus the 2-year yield. And so basically, when it uninverts, you typically, within about 12 months or so, give or take, you get a recession. So you can see, if you go back to these previous periods where the gray bars indicate recessions, that it's had a pretty good record of forecasting this. So again, you know, we're not here to forecast economics. What we care about is, what are the big bazookas going to do? Project Zimbabwe, Money Fest 2024. We now basically are anticipating that the Federal Reserve will join the majority of the other central banks in the G7, G20, if you will, in cutting rates. This will also line up with basically what's been going on around the rest of the world in the emerging markets, various other markets around the world, which we've been tracking, that basically the world entered a rate cutting cycle in August of 2023. So for a year now, we've had more and more central banks cutting rates than raising rates. And again, this rate cutting cycle is going to operate with a lag, just as the rate raising cycle operates with a lag. It's not like you cut rates and then the next day it flows into the market. They cut rates over time. These things flow into the market. People refinance, they take out new loans, what have you, whatever it is. The idea being that it's going to stimulate demand for new credit, which stimulates the economy. I'm not going to go through the whole thing. So what we care about is that, how is the money created? How is the new debt created? And what does that typically do to the things that we're invested in, which are like, what's the relationship with the dollar? The U.S. is cutting rates. Does the dollar go down? If the dollar goes down, what does that do to commodities? They typically go up. What does that do to gold? The dollar's down, it typically goes up. So this is why we care about this. Not that we're trying to forecast economics or whatever. It's very hard to do. We just want to know when the bazookas are going to be fired. And again, it's usually not one and done. This is usually a cycle, right? So I'm just pointing out what's happening and what has happened in the past. So again, until all of this flows through the markets, typically what we've seen in the past, when they start the rate cutting cycle, when we have the yield curve uninvert, we typically get a recession. So I think we're already probably in a recession, obviously in a manufacturing recession, but we'll see. We'll see what happens and go from there. Credit card defaults at record levels. We're at levels now. I think I've pointed this out when I see new charts. We're at credit delinquency rates on credit card loans worse than what we saw during the great financial crisis and during the tech wreck recession. So this is not boding well, in my view, for like consumer spending. This is what I'm trying to point out, that the consumer is basically tapped out. All of the free money's been spent. The savings rates collapsed. And so in order to maintain people's lifestyle, and in many cases, a large part of the population is actually living off credit cards, which makes sense, right? If you've had prices go up like they have over the last 4 or 5 years. And we've talked about that before, but this, to my mind, is not conducive to a big surge in consumer spending. Now, again, we've said before that we think the consumer is bifurcated, where we have people that are wealthy or well off that have participated in the asset inflation and bubble, are able to spend money, and the people that live hand to mouth, they're having a tougher time. They're having to spend whatever they can get and then dip into credit cards. But this is not positive in my mind. And here we are here, like food prices are at an all-time high. This is food CPI, food at home versus food away from home. You can see it generally goes up over time because we do have, slightly higher inflation. But then you saw, after the pandemic and we shut the world down and printed all this money, we had this big inflection upwards in food prices. And that happened with a lot of prices. And people's wages didn't go up 25%. This thing's up, from 240 on the index, something like that, 250, let's say, on these indexes, to over 300. So that's like, a 20% increase in 4 years in food prices. And we've seen the same thing in insurance, house insurance, auto insurance, medical, blah, 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 down the line. And so I talk about in the September issue of the Actionable Intelligence Alert newsletter, the paid subscription, I talk about Back to the Future is the title of the article. And what am I talking about? Back to a future of structural inflation. We were in a basically 40-year long-term kind of inflation under control, lower interest rates, and why that happened. I talk about that and why the circumstances. It wasn't just Mr. Volcker raising rates in 1979 and 80 to like 20%. That helped crush inflation, but there were other structural things that came online that were one-time events that culminated in driving down prices over the last 40 years, which drove down interest rates, which led to the financialization of the economy, tangible assets becoming less valuable and financial assets becoming more valuable. I get into that in the newsletter. It's a tremendous article, I think. I think I spent like 3,000 words, and I didn't even cover even half what I wanted to cover. So it'll be an ongoing series. But I think, the reading I've done has led me to believe that we're now, the things that allowed for this disinflationary environment, that allowed for rates to be down for, you could have bought long-term bonds in 1980 and locked in 15%. And then as rates went down from 15% to, generational or millennial lows of, less than 2% or whatever they were, negative rates in many countries, if you remember that, you would have had tremendous gains on your bond portfolio. And I pointed that out. And those things that allowed for that are now reversing in my mind. And so they're not going to be like 1-year events. These are like generational things that are reversing that I think are going to lead to structural inflation. Obviously, we've talked about the debt that the West has, how it's going to be monetized. That's one factor. Just a bunch of other things that go into it. And I really, if you're interested in this, because I think this is the key for the next 10, 20, 30 years in investing, where we see a phase change from investing in financialized assets back into tangible assets. It won't be a 1 or 2 year thing, and it won't be a straight line, but I think that's where the future is going to be. And not many people, I think, are seeing this phase change. Just like what happened, I talk about it in the newsletter, that the phase change that happened in the late 70s, early 80s, away tangible assets to financial assets, many people didn't catch on to that at first. And people were fighting the last battle. Talk about my own experience. But I think you have to grasp these things. And I think what's happening here is, like, the Fed, for example, still thinks that they've got inflation in the bag, that it was pandemic related, but I don't think they've caught up with some of the And I think, cutting rates like they are, this is why I think some other commentators have been advocating for this, kind of like what happened in the 70s, where you had the first wave of inflation, then they raised rates, kind of knocked it down, and then they didn't understand what was really happening, and they cut rates again, and then you had a second wave of even higher inflation. So I think now that transpired over years, and it was part and parcel of things like going back to the Johnson administration, where you had excessive government spending after the Civil Rights Act on all these programs and the Vietnam War, and they called it guns and butter. So there was a tremendous amount of deficit spending. And then, as we all know, Nixon took us off the gold standard I think in 1971 was it? And then, well, we all know the history. So I don't have time to get into that now. That's in the newsletter. It'll be an ongoing investigation and series of articles, because I think it's that important that if you don't grasp that, I think, this idea that you're just going to do what you've been doing for the last 10 or 20 years and it's going to continue to work, is things are changing now. And I've been talking about that, and I get into more detail and put more thought into kind of the thesis. So I'm not sure if everybody's getting that, but that's what my analysis shows me. But I think the Fed's still fighting the last battle. They think, well, the supply shocks from shutting the economy down are past. The free money from the federal government going out to everybody's past. And so inflation will go back to its 2%, and we can be ahead of the curve and cut rates. And I don't think they really understand the structural changes that are happening that they have no control over. But again, it's beyond the scope of the weekly call, of the weekly update. You have to go to the newsletter, which you have to pay for. And you can do that by going into the show notes. The link is there. So this is what I'm talking about. This is a perfect example. You go back in time and you see that the market is very concentrated. The most concentrated it's been in a small number of stocks in 40 years. This is, I think, a large part and parcel to the passive investment trend that's been in place for 20 years with 401ks and IRAs. Just put your money in an ETF, 288 a payday, and you're not, that's beaten active investing, because you've had these money flows into that. And obviously, if you put $100 into the S&P, it's divided, these ETFs are structured by market cap. Nobody analyzes the stocks and picks them in the ETF. If you buy an S&P ETF, if you put $100 in, it gets allocated across, and so it has a tendency to get concentrated. Okay, what's working gets a higher market cap, like tech, and as more money comes in, it turns into kind of a flywheel effect. And so this is so out of bounds of what we've seen in the last 40 years. Is it sustainable? If I gave you $1 million, here's what you have to do when you look at charts like this. This is how I analyze it. If somebody gave me $1 million and said, you have to commit this money for the next 10 years and you can't touch it. Would I want to be long this chart or short? And I would want to be short, because I don't think that this is sustainable. Does that mean it can't go higher for some period of time? Yes, but I just don't see it being this sustainable, especially considering the things that I'm talking about as we move forward, the changes that are happening in the world. That's these monumental geological shifts in the geopolitical order and economic order in the world that most people are not picking up on. I just don't see it. So considering that, what am I buying? Well, this is what I like. This goes back to 2004. This is a Bank of America research chart. And what you have here in black is the spot price in gold over here. It's making new highs, as we've talked about before. And here's what you have in ETF gold holdings. Okay. And typically, going back 20 years at least, as the spot price went up, the holdings in the gold ETF basically tracked the gold price. But we've had this divergence over the last few years where the gold price has made new highs, yet gold ETFs, and this is representative not just of the ETS, but gold in general. People in the West just are underweight gold, individual retail investors and institutions. And I think I've put some charts up before where I think less than 1% of financial advisors have their clients an allocation of any gold whatsoever. And so I think this is going to change. Again, it kind of goes back to what I've originally talked about. Gold flows to the global east and south, having to do with the geopolitical and economic transitions that are happening away from the Anglo-American hegemon to the global south and east, which is going to continue, in my view. And not only is power and global economic activity going to shift to the global south and east away from Europe and the United States, but we're also seeing gold flows go from west to east. So I think eventually, if the gold price it's in a bull market. I mean, we're breaking out on the gold price to new highs. I think with all of the things that are happening in the world, gold's probably set up, it has a lot of tailwinds. And so at some point, people catch on because it's a thing that's moving. We still haven't crushed out the sentiment, the positive sentiment out of the tech sector and what's happening in the US. But I think that, with what's happening, we're going to have a bear market eventually. And then I think that's when, people will be seeking out other sectors that are working. And I think as gold continues to make new highs, which I expect it to do over the next few years, that eventually this reverses, and this has potential in the metal itself and in certain miners, gold mining companies. So let's talk about uranium. They had the WNA conference in London last week. I've been getting bits and pieces of information, and I'll report more on that. But I just wanted to point this out. This is the long-term chart of uranium, the term price, reported term price, not the spot price. And, the term price is up 37% over the last 12 months. You see the definite uptrend. And yet we have suicidal sentiment in the uranium stocks. Yes, they're down a lot. Some of them are down massively. I'm not going to handhold. The thesis has not changed. It's just as bullish as it's ever been. And it's even more bullish when you listen to some of the people that have their ear even further to the ground than I do. I'm not a uranium expert. I'm a generalist investor. But, there's still complacency, evidently, among Western fuel buyers that there'll be plenty of uranium, not worried about it. And again, not really paying attention to what's going on. And, the other feedback I've heard is that, well, the price increase over the last year really shocked people. And so they said, well, let's just hold off on buying because the price will come back down. Again, see, when you have years and years of low prices, people get complacent. They get recency bias. This is just an anomaly. This is speculators. This is, sput in the market. That'll die off and then prices will go back down. They will buy. And that's not really the case. So that's some of the feedback that we are hearing. But again, I can't speak to your individual uranium exploration or development company that has no good asset and is never going to produce uranium and why it's down 50%. I said in the newsletter, and what I've said on these calls or these videos, that I transitioned out of a lot of the more speculative names probably a year ago, at least to this point. And what I have done is moved more into companies that are actually producing uranium or going to have uranium production happening, okay, in the recent near term. Not science guy, not, well, at some point they're going to do something. No, you're either producing uranium and growing your production, and there are companies that are doing that. I want producers or near-term producers to take advantage of this situation. I think that you will get eventually sentiment will turn. This is a market that's very small market cap wise, and it's dominated by swings in sentiment and retail investors. Big, super big institutions are not in this market yet. I suspect they will come in at some point because, again, shiny object and FOMO. But right now, people are enamored with tech and what's been working. And so there's no interest. That doesn't mean the fundamentals have changed. And so I just chip away. I buy a little here, buy a little there. I ignore the, calls for ritual seppuku on Twitter. There's a lot of, like I said, sentiment that's very negative, but nobody talks about the fundamentals. They just say, all you uranium bulls have been wrong. I get a kick out of these swim people. It's like, it's really a really fun for me because it's a psychological exercise in watching people, certain commentators try to, you either have a thesis that you've built and you have conviction in something and you understand that you have to be patient for things to work out. And if you've gone through this kind of process before with other speculations or investments, you know how it pans out. And so you have to be patient, and things always take longer than you want them to take. And things are never as good as you think, and they're never as bad as you think. Okay. And I can give all these cliches about Buffett saying, well, the stock market's there to separate the impatient from their money and give it to the patient. I can say all this stuff. I can quote Peter Lynch. I can put, Howard Marks quotes in there. It doesn't matter. You either have the thesis and you understand it, which creates conviction, or you're just a punter that, whatever stimulus. And people say, well, I'm just going to trade it. If you're a trader, then why are you on Twitter telling everybody that? What people really want is validation. They want people to agree with them because they're nervous, they have anxiety, they're not sure about what they're doing. So they're gonna be the big trader. I hope it works out. I'm sure there's some guy that's trading every one of these, rallies and then sell-offs and is just compounding their wealth. They're not going to come on Twitter and tell everybody. So it's a psychological exercise. You either understand this chart and why it's the way it is, and you understand what's happening in the world and what's that going to do to the supply and demand dynamics around uranium, and then you act accordingly. And then you have to sit and be patient. This is how I've been paid off many times throughout various investments. And again, they always take longer than I wish they would take. Sometimes you get paid off, it's very infrequent. You just got to go through. You just got to keep chipping away at that ore body until you break through and hit the vein. Okay. And so it's hard. It's not easy. And so again, if you have capital, you're being given discount prices relative to what we've seen recently. That doesn't mean that some of the things aren't still overvalued. But again, this is a very small market, and when capital flows in, it moves quickly. And when capital flows out, it has a tendency to do the same thing. But I don't see anything fundamentally has changed. As a matter of fact, I just have to say, it just keeps getting better. I mean, that's what just baffles me. But again, I understand psychology. I understand inexperience. I understand these things. And if somebody comes at me and says, well, you guys been so and so said this, so what? What do you believe? Your capital is being put to work by you. What's your thesis? Explain to me, if the prices are down, why they're going to stay down for these stocks. One thing has to give, okay? Either the thesis is wrong, then explain why it's wrong. They're not going to build all these reactors. All these huge mining companies are going to all of a sudden next week make all these announcements of billions of dollars in investment in new uranium mines. No one's building any new uranium mines. Yet week after week, I keep putting on here more reactors being built, concrete's being poured, steam generators are being manufactured. I mean, so it's an inevitable thing. because it's not doing what you want it to do when you want it to do it. I've said this before. That's just going to separate the people that become wealthy from this and the people that don't. This is a multi-year, long-term play. So if you have, and somebody will say, well, if you bought at the top, then you got a lot of pain. But does that change the fundamentals because your timing was off? No. Is it painful when you're down 50% to keep buying? Well, that's for each individual's, how much your constitution can take and how much your, stomach acid and how much Tums you want to eat, I guess. It doesn't affect me. I have this like genetic code and just the experience, I think, of being in these situations that when I have a high confidence, when I'm given two aces, I mean, I know what my probabilities are of winning the hand, depending on my position and what the other, so I'm going to play this a certain way. I'm going to keep accumulating when prices come down because I don't see anything changing unless I see all this massive supply come online, or if I see a nuclear accident on Monday that, changes sentiment towards building more plants, which even if you had a nuclear accident at this point, the world needs more nuclear. It's just that simple. And again, watch what's happening in the global south and east. We're getting our doors blown off by China and Russia and India in this industry. It's an industry that we should dominate, the United States. We're not doing anything. Again, forget about renewables. Spend $1 trillion building guaranteeing and streamlining the process to build 1,000 megawatt reactors here in the U.S. That's what they're doing in these other countries. So again, I can't give you the conviction. It's just simply, and I'm saying this, I'm not picking on anybody. I'm saying this with all sincerity. This just isn't for some people. It's just so too volatile for some people. That's why in the portfolio, we have a dividend portfolio where we buy companies that pay good dividends. They're very solid companies. They don't have much volatility. And, if you're lying awake, tossing and turning, then maybe something less volatile is what you need to be looking at. But I still have full confidence and full conviction in the thesis. And I believe it's multi-year. And I think that, I think we're going to have a musical chairs situation. We're simply just not going to have enough uranium. And somebody's going to, that's going to be something that could be a catalyst. I think somebody's going to wake up and say, hey, wait a minute, we can't get any uranium for our reactor. Now it'll be interesting to see what comes out of some of the players that were at. A lot of people went to this WNA conference this year. Different Twitter guys that I follow. I know Cuppy was there, so I'll be hearing from on the weekly reports that we get from the newsletter that he has there. And so it'll be interesting, but I suspect that what I have heard so far, again, is a lot of complacency by fuel buyers, people not really understanding what's happening, and just the view, because of the recency bias, that if we need uranium, we'll be able to get it. So we'll see. But this is what I focus on. Term price, it's up 37% in the last 12 months. I mean, it is what it is. So I thought this was interesting. It was a recent interview with John Campaglia from Sprott. He's the guy that's like running all these ETFs over there. And one of the things he said was, there's this view that he's had conversations with different fuel buyers and people in the industry, and they seem to think that, hey, I'm not really worried about it because this SPUT thing is just kind of like a savings account I can dip into. I'll be able to just, do a swap or borrow pounds and pay them back at some point, or they'll sell me some pounds. And this is what he had to say during one of those calls or one of those interviews, quote, utilities seem to think SPUT's uranium inventory is up for grabs. We've never lent or sold a single pound. I've told hundreds of fuel buyers on stage, go buy your own uranium. This isn't 2008 to 2009, unquote. Now, the retort will be, Yeah, that's what they're saying now. But what happens? Yeah, anything can change. The mandate of the fund, of the ETF, can change. They may go to the shareholders and say, hey, these utilities are begging us for pounds. We can sell them at, market plus this. We can loan them and get this much of a return. That could all happen. I've had other people I've heard say, well, at some point, John, if a shortage happens, like you say, the government's just going to confiscate it. All very possible. But what are the actual odds? So that's why you're not in the uranium market, because at some point the government's just going to confiscate. So that gets you what, 60 million pounds, and then what do you do after that? So yeah, when people make different, I fully expect that that's probably what will happen at some point once we get the musical chairs event. And look at the United States, for example. I've said this before. I think it's 19% of the base load electricity in the US is supplied by nuclear, and we hardly mine or process any uranium here in the United States. We have a nuclear ballistic missile submarine force, and our large capital surface ships like carriers are nuclear powered. This is a national security issue. Yeah. In some situation like that, I could see something like that happening. But that's not really my investment thesis. Those are low probability events, kind of like when the space shuttle launched and the O-ring was a low probability event, but a big impact. So if something like that were to happen, I think you would see a big run up in price first and a lot of commentary well before something like that happened. The government is not going to be on the front end of that. They're always going to be on the back end. The market will sniff out something like that well in advance and drive prices. And then, I think you'll have plenty of information telegraphed well in advance of something like that happening. You're not just going to wake up on Monday morning and the government of Canada or the US is going to say, we're confiscating sputs. I just don't see that happening in the near future. And again, like I said, if we get in a situation where that started becoming a rumor or people were floating that idea, the bureaucracy, the way it works, it would take time. It would be well telegraphed to the market. But again, can they change the mandate of the fund? Yes. If you get an offer that's too good to refuse, if say that uranium was trading at, well, it's trading around $80 a pound right now, right? On the term price, they say, hey, look, we're willing to pay you $100 a pound for 5 million pounds. I don't know, would they take it to the shareholders and say, hey, you want to vote on this? Because this is what we're being offered, Or utility comes and says, hey, can we borrow 1 million pounds and we'll pay you this much interest on that loan and we'll replace it by this time, and there's penalties if we can't. I mean, that's all very possible, but that's not the current mandate of the fund, and it would require shareholders to vote on it. So all these things, anything's possible. Anything that can be thought of can be done. I mean, that's what we've seen before, especially in these markets, but it's not something I would worry about in the next year or two. So here we go. This is more news. So we've already had China saying they're going to build more reactors. We've already had India come out and say they're going to build more reactors. We've had various countries in the Middle East like UAE, Egypt, the Turks going to build more. And now we have Russia is going to add 28 gigawatts, which is 28,000 megawatts of power to their energy grid. This is of new nuclear power by 2042. So basically, essentially 2 new reactors a year for the next 18 years, bringing total nuclear capacity to 25% of their grid. Exactly. That's what we should be doing. And what I think part of the thing that people are missing that kind of ties back to my original thesis, the global East and South and the BRICS, emergence of this BRICS block, trading block, is going to support each other. Where are all the resources located? Kazakhstan, okay? I know Canada has a huge resource, but a lot of this stuff's going to flow to Russia, China, India, okay? And less of it's going to flow to the West. Now, Canada has a huge reserve. The United States still has decent reserves, but they're just capital starved. No one's doing anything. And as we're going to show later on, it takes more than a year or two to get a mine up and running. So here's that Cantor Fitzgerald. This is floating around Twitter all the time, or X. And you see basically the reactor requirements, non-China in gray here, with China in this, I guess, pinkish flesh tone or whatever. And you see the bars demonstrating the various supplies. And you see the continued ongoing and growing supply-demand deficit, which I would suggest to you is going to get worse, because I think actually that you're going to see even more acceleration of move towards nuclear as people realize that, you're not going to, what happens in 10 years when everybody realizes that the billions and billions of dollars they spent on these solar farms that deteriorate at 1% a year aren't generating what they were generating, and that the batteries that they bought and spent all this money on for battery storage only last 10 years. All these things lose, just like your battery on your cordless drill or on your phone doesn't have the same capacity year after year. It deteriorates over time. When people realize this, they're going to say, well, really, all along we should have been going to nuclear, because if I build a 1,000-megawatt plant, it has a very high reliability factor and availability factor, and it just runs and runs and runs for decade after decade after decade. And I think that's what people are going to realize. So I think that until I see somebody, again, announcing like a Rio Tinto or a BHP or a Glencore, hey, we've decided that there's a big shortage in uranium and we're going to do this, this, and this, and we're going to spend $10 billion and we're going to create this new division and we're going to take over some of these mines and make these deals, okay, when's that going to happen? Where's the capital? What's next gen doing? They have that tremendous asset in Canada. I talked about last week, they're 2 or 3 years or more just on the environmental that they still have to go through. Where's the capital? Now, can that be accelerated? Yes. Can that be streamlined by the government? Yes. Can somebody decide that they want to partner with them and inject the capital? Yes, but it would still take years. You're not seeing these announcements. You're seeing brownfield guys bring stuff on, 500,000 pounds here, 1,000,000 pounds there. Okay, Langer Heinrich, 4 to 6 million eventually. It's not enough. It's not enough. So we've really seen a tremendous amount of weakness in the oil market. Oil demand continues to grow. Again, there's a big paper market. I don't know. I don't try to forecast oil prices anymore. I gave up a year and a half, 2 years ago. It's too difficult. I do know that slight changes in oversupply or undersupply can swing the market. And there's a lot of angst now because of people's sentiment towards a possible recession in the US, the ongoing perceived economic weakness in China, which it is fairly weak. Global manufacturing PMI is under 50. Okay. But the global PMI with services is above 50. So you have a mixed amount of signals economically, and you have a lot of people with paper trading swinging things left and right. But I'm still bullish on oil. Now, I saw somebody say the other day, a guy that I actually respect, he said he thinks oil can go down to $35 a barrel in the next 6 months or a year. I guess it's possible. Is it going to stay there? I don't think so. We have global synchronized central banks cutting rates around the world in Money Fest 2024 and Project Zimbabwe breaking out everywhere. Okay. I don't know how oil stays low in that environment. Again, the rate cutting cycle, the rate raising cycle because of the pandemic inflation is over as of last year. Cumulatively, central banks have been cutting rates since this time last year, basically. And so it takes a good year for things to move through the economy. And we haven't had the big guns in Europe, in the US, Canada, Bank of England have just started their rate cutting cycle. They were the last ones to increase rates, and now they've been the last ones to cut rates. And so even if we do get some short-term weakness in the oil price, even if it goes down into the 50s or 40s, I just don't see it staying there. And if you're in mining, your diesel prices will go down tremendously. So it's actually a tax cut. So it actually helps when prices go down, demand goes up. So we'll see. Again, I don't try to forecast these things. I just buy good companies that are well run, that have got their debt paid off, and that can cash flow even at these lower prices and are buying back shares and paying dividends. I think, I don't have to go into some speculative stuff. Total return with buybacks and dividends gets me, high single digit, low double digit total return, shareholder return. So here we go. This is from S&P. Global PMI up, services strong, and manufacturing weak. Here was some of the commentary. This is for August. Global composite PMI output index rises to 52.8 in August. Growth of new order intake strengthens. Input costs and selling prices rise again. So we have that rising orders, but we also have these rising costs. It says August PMI data from across the world pointed to a widening disparity between the manufacturing and service sectors. Service providers saw an accelerating upturn, with activity levels rising at one of the fastest rates since mid-2023. In contrast, conditions in the manufacturing sector deteriorated further, with output, new orders, and employment all contracting. So again, this is why you're kind of in that, I talk about, if you're from Florida, you know about the various inlets on the East Coast. Sebastian Inlet, the inlets down there in Palm Beach, and down towards Miami. And when the tide changes, you're trying to go in and out of these small inlets, and you have water flowing in and out. And there's a period where it doesn't really flow at all. And it's best to try to catch your entry or exit then. But once it's flowing in or out based on the tide, it becomes more difficult to navigate. And this is kind of the situation we're in here. We're kind of in that eye of the hurricane type situation, I guess maybe is even a better analogy. And then, but what happens when the other side of the storm comes? So we're kind of in that, okay, services are doing good, but manufacturing isn't doing as well, but yet orders are picking up. So, but then we have the tailwind of a global synchronized rate cutting cycle. What happens? So I think we're in for some chop over the next 6 months to a year, but I think, we have the tailwinds are going to help us for the sectors that we're interested in. And I think with relative to equities, commodities and resources are basically at generational lows. I still think that's where the opportunity is. So this is from Goldman Sachs. This is referring to gold. This is from a recent report they had. It says, in this softer cyclical environment, gold stands out as the commodity where we have the highest confidence in near-term upside. More specifically, we maintain our bullish $2,700 an ounce target for early 2025, and we open a long gold trading recommendation for 3 reasons. And the main reason here is what I like, and kind of ties back to what I talked about earlier and what I talk about in the newsletter this month. We believe that the tripling in central bank purchases since mid-2022 on fears about U.S. financial sanctions and U.S. sovereign debt is structural and will continue, reported or unreported. This is what I actually believe. Also, gold is flowing from the west to the east. And I said before, because of the seismic shifts that are happening economically and geopolitically, and the way that the world's aligning between these two bipolar areas, where you have a declining hegemon now in competition with kind of a loosely affiliated hegemon, or trading block, what have you, however you want to describe it, axis of evil, some neocons would probably say, but proof's in the pudding. They see, you don't think that the people that are running the central banks in Russia, India, China, Malaysia, Indonesia can't see what we talk about on these videos, that the United States is running these unsustainable deficits, that's adding to its debt, that there's no responsible people in power anywhere in our government, that we have an out of control bureaucracy and oligarchy, and they're just going to keep spending money. And so why would you want to be holding, if you're trading with the U.S., and again, the U.S. is still a very large part of the world economy. It's still about 20 between 20 and 25% of the world economy with 6% of the world's population. It's still going to be a factor, just a diminishing factor. And Europe, forget about it. I don't know what's going to happen to Europe. That's a whole nother question, what happens in Western Europe. But this, I think, is one of the catalysts for gold. And it's a major catalyst. I don't think it's going to reverse anytime soon. Not with the U.S. sanctioning, and we talked about this, I think it was last week or the week before, that they've got 60% of the emerging market countries, which are all looking at the BRICS for leadership and to join them on some type of sanction protocol. So why would you want to be holding US dollars? Now you have to a certain extent, to do commerce still, but it's going, again, it just needs to change at the margin. That's what it's doing. Doesn't mean that the dollar, Peter Schiff dollar collapse next week. It means long-term shift at the margin with a trend in place. That's what we're talking about gold being held by central banks. Nothing's going to happen geopolitically, in my view, to change the view that the U.S. is not a good actor and a good partner. So here's a tweet. I've been talking about this before. I'm kind of conflicted on this idea. You know, title of the slide, Chinese stocks are stupid cheap, but it goes on here. It says China valued at just 40% of U.S. markets. There's cheap and there's maybe too cheap. Chinese stocks are now trading at just 40% of U.S. stock valuations. That ratio is now 2 standard deviations below the historical average. Catalyst still unclear, but when that comes, are global investors sleeping on a once-in-a-lifetime opportunity in China? Now, I've read some people I respect that, you know, have a more positive view on China, but my problem is that I think there's ways to play this. Like I said, I've been interested in some Singapore situations in Hong Kong, but you know, the U.S. has called out China as its major geopolitical adversary going forward. And so they've already started anxious sanctions escalator, okay? And do we end up in a situation that if you go buy Chinese stocks, that the same thing that happens? You know, Russian stocks, I made a lot of money on Russian stocks. They paid very good dividends. It wasn't, nobody was confiscating my assets. And then the U.S. passed a law arbitrarily to say I couldn't own them anymore. And I basically got stolen from me by the administrators. Made no effort. I'm not going to get into that. But the same thing can happen here. And so that's, even though they're cheap for a reason, and there's risk there. So it just depends on what the political situation, regardless, you know, if you get a Kamala Harris regime, you're just going to continue on with this neocon, neoliberal, Anglo-American hegemon in decline, trying to hold on and calling out China. And then Trump, you know, he already demonstrated last time he was president that he slapped a bunch of tariffs on China. And so I don't know why you would want to, yes, it's stupid cheap, but if you're in the US or Europe, your governments are calling China out as a number one geopolitical adversary, an economic adversary going forward. And so, like, again, they love to sanction. Even though the sanctions don't work, they love to sanction. And they love to tell you what you can't do as a private citizen as they run around and play master of the universe. So buyer beware, I guess. They're cheap, but I'm just not prepared to go in there yet. And here's the issue, right? This is another thing that ties into what I've been talking about. So there was a report came out, it's this ASPI, which I'll expand more in the weekly free email, give a link to it and what it is. Basically, it's Australian outfit. It's kind of a neoliberal outfit, but basically the idea is neocon outfit, but basically it's like title of slide, China is blowing the US away in critical technologies. And so this is kind of a synopsis of what's going on in the report, which I haven't fully read, but I'm going to over the weekend. And like I said, I'll put it in a link to it and more expand upon it in the weekly free email on Substack, which you can subscribe to in the show notes. But anyways, here's the tweet. This is genuinely extraordinary. The latest ASPI critical technology tracker is out, And China is now in the lead for an incredible 57 out of 64 key technologies of the future, i.e., 90% of the technologies. The US leads the other 7. Remember, I think it was not even 10 years ago when there was a uh, article. It was a headline article, which I saw in another tweet, which I'll post, where the Economist magazine was basically calling out China as just being, they couldn't make anything. They couldn't think critically. They're just copying. It's basically a place where they build, plastic doggy duty and Minkman schnozzes. And that's all it's good for. And, assembling iPhones. Well, now we have a neocon, neoliberal outfit think tank, which is in the tank for the hegemon, basically saying China is leading in 57 out of 64 key technologies. This is what I've been talking about. This is what Louis Gov has been talking about, Louis Gov. Don't believe the propaganda about the global South and East. It's not Shangri-La and perfect, but it's not a joke either. And we're slowly losing our grip. And so when they are wanting to have trade, when they're taking over industries, I mean, they're dominating now the global automobile export industry. They are shipping cars all over the global South and East. BYD produces a $10,000 electric vehicle. Okay. And so what's Europe doing? What's the United States doing? Okay, the United States has run around for the last 20 years, instead of investing in infrastructure, nuclear power, energy technologies, computing technologies, all the stuff that we should have been doing, and fostering trade relationships and being a benevolent, wanting to trade with all and fighting with no one, and looking after the welfare of the people of the United States. We were having war after war. And here domestically, we were talking about transgenderism and who could use what bathroom. These people are laughing at us, and we are going to suffer. This is what I mean by terminal decline. Another one of the articles here, it says, or parts of there's a whole thread. The key findings in the latest August 2024 edition are sobering. China leads out of 57 out of 64 technologies, up from just 3 20 years ago. They let in 3 critical technologies 20 years ago. And 10 years ago, the Economist magazine was making fun of China. They couldn't do anything there except for, like I said, make fake doggy duty, plastic doggy duty, and Minkman schnozzes. Then it goes on another blurb. The U.S. lost its research advantage. It was leading in 60 technologies 20 years ago, down to just 7 today. Is that even recoverable? Who's talking about this? Yeah, they did the CHIP Act. That's not really going very well, though. What's the plan? I saw another, I'll try to find it and put it in the weekly article. Like 90% of the critical minerals we need are controlled by China for our defense industry. Is that sickening? A lot of the raw materials and medications that people take in the US are manufactured in China. We don't do anything here anymore except for go around the world and stick our nose in everybody else's business and create wars to enrich the military, industrial, congressional complex oligarchy. And in the meantime, a government that will not look out for the welfare of its people loses its mandate to rule those people or govern those people. Get it? That's how I think. Bringing in, opening the southern border, running up all this debt, running around the world sanctioning and declaring war on everybody. And in the meantime, our infrastructure is falling apart. We have 100,000 plus people dying of fentanyl every year. We don't have a southern border. Our every inner city is a war zone and in collapse. Our infrastructure sucks, and the place is a dump. And yet, hey, China, you guys keep listening to Kyle Bass. China's going to collapse. He's been saying that for 20 years. Better wake up. So this is what I was talking about mining. It takes longer than a year, and the timing gets longer and longer. further you go out. Okay. You know, back between 2005 and 2009, the mining lead time based on production start was 12.7 years. Now, basically, you know, 15, 20 years later, it's 18 years. And it seems to be increasing over time. Why? Regulation, lawsuits, bureaucracy. Again, I've pointed this out before, the hypocrisy and the nonsense of this government here in the US or in the West in general. We want to have, whether you agree with it or not, okay, you want to have a Green New Deal. It requires certain minerals to do that, things that need to be dug out of the ground. And yet, we've had this administration who wants to have this transition that requires stuff to be taken out of the ground to do, stymieing efforts to bring on domestic production. Does that make any sense to anyone? Now, take it out of the conversation, the discussion around whether you should even have a government Green New Deal. That's irrelevant. That's what is happening. That's what they're advocating for, the current administration. That's what they're spending money on. And yet, the other side of the bureaucracy, the administrative state, is doing everything it can to hinder the development of copper mines, rare earth metal mines, things like that. Then you have NGOs and these organizations tying up companies and efforts in court for years, so people just throw their hands up and walk away. You're telling me that it's impossible to develop resources and do it in a manner that is responsible and sustainable? It is possible. Just to say we're not going to have any development at all is ridiculous and is not compatible with your other themes and your other wants and wishes. But this is good for us as investors and speculators because it's going to take longer and longer and longer to bring that new supply online and to fix the results of the underinvestment. That's why there's long-term such a tremendous opportunity in these sectors. So I want to talk about this because, yes, I think that the United States and Europe are in terminal decline. That doesn't mean that there aren't investment opportunities for short, medium, and even long term. That doesn't mean they're going to collapse and dry up and blow away. The British Empire basically went away after World War II. Decolonization of, Indian independence. You can read about that if you know anything about history over a period of 20 or 30 years. Okay, did that mean that the UK dried up and blew away? And no, what it means is things get restructured, things change, but that doesn't mean that there isn't opportunity. And I think what I've seen, especially in my Actionable Intelligence Alert dividend portfolio, is consistent with what Meb Faber's talking about here from Goldman Sachs, which I recognized a while back and have been taking advantage of. And here's the quote from the report. European company, well, basically the title is like buyback bonanza in value stocks. European companies used to eschew share buybacks as they chose to focus on dividends or investments / mergers and acquisitions, the latter often providing only low returns. With valuations in certain sectors low and profitability high, share repurchases have risen sharply. 60% of European companies are now buying back shares compared to around 20% historically. This buyback bonanza is concentrated in financials and energy, and in both cases, the combination of dividends and buybacks means investors in these sectors are seeing cash return to them worth around 9 to 10% market cap per annum. We expect this trend to continue. This is exactly what I've been seeing. This is why I talk about European banks, for example. European banks were run very badly for many, many years. Okay. And so after they went through the financial crisis, they basically froze. Okay. They weren't making a lot of loans. So what happened when rates went up? Net interest income exploded. And so they weren't making a lot of loans. They were buying government debt. They were making very safe loans, but at higher interest rates. And again, their cost of capital was low. And so they were minting money, and this stuff was just piling up on their balance sheets. So they got to the point where they were overcapitalized. You know, banks have to maintain certain reserves to meet certain regulatory standards that are set by the central banks and regulatory authorities in these different countries or economic blocks. And so when they become overcapitalized, that they go back and say, hey, look, we're overcapitalized by so many, whatever, hundreds of millions or billions of dollars, and we really don't have a lot of prospects to loan this money out, so we'd like to return it to shareholders via dividends and buybacks. They make their proposal, and then the regulatory bodies look at it, and they either approve it or disapprove it. They've been approving it. So you have many banks in Europe that have been doing this and under the radar. And so I've been participating in that because one of the factors I want, and it's the same thing with energy companies. I have two major European oil and gas behemoths in the portfolio, dividend portfolio, because they're growing share buybacks and they're growing their dividends. They cast off, one of them in particular had a big management change and a philosophy change. Yes, they're not going to 100% abandon renewables and energy transition. They have to say that stuff because that's the zeitgeist in Europe, but the focus is back on their core competencies, producing energy okay. And so focusing on that, focusing on operations, yielding cash goes into buybacks. It's the same thing you saw here in the US, which started a couple of years ago, where a lot of the companies spent $300 or $400 billion drilling shale, and there was no net positive cash flow, and enough was enough. Drill baby drill went away, and then the management's turned over, and you got to focus on shareholder returns, where the drilling was slowed down, was done in an intelligent manner, and the focus was put on new managements put in, and the focus was put on shareholder returns, buybacks, and dividends. So the same thing is happening here. Does that mean I'm bullish long-term on Europe? No, but it means there's a window of opportunity. I've talked about the fact that Greek banks now have just been granted, perfect example, go look it up. Like in the last 2 or 3 months, they were so overcapitalized. Remember a decade ago when they went through the financial crisis in Greek and there were bank bail-ins and Greece was going to collapse and blah, 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 blah. Well, it was the same situation. You get it under control, you fix it, they bring new managements in, and now they have been approved even to pay back, to give shareholders dividends and buybacks. And so this is the kind of opportunities that I look for. And I think that doesn't mean that I'm not long-term bullish. I wouldn't want to move to London or Paris. But I think there's an opportunity here for some period of time. Again, this place is not going to dry up and blow away. And there's always pockets of opportunity. This is a perfect example of what I'm talking about. And this is kind of what I focus in the dividend portfolio of the Actionable Intelligence Alert newsletter. Looking for, yes, growing companies that are going to have growing dividends and buybacks, but have the ability to have the perception change from terrible to less bad, which can also give us a capital gains kicker. So if that's something you're interested in, you can take a subscription and view that. Okay, that's it for this week. Appreciate the following. Appreciate the views. We continue to grow slowly but surely. It's a grind, but we thank you all for subscribing. We thank you all for watching the videos. We thank you for the comments, good and bad. And we'll talk to you next week. Thank you.